The market is not collapsing because investors suddenly became emotional. It is collapsing because the system is finally pricing the part nobody wanted to price. A trade war sounds political on TV. In the market, it behaves like a tax, a supply shock, and a confidence break at the same time. And when those three hit together, stocks do not wait for the damage to show up in the news. If you like hearing the part that usually gets cleaned up before it reaches the public, stay close to me here, because this is one of those moments when the headline is loud, but the mechanism underneath is even louder. I have watched this pattern for a long time, and the first thing I do in a sell-off like this is ignore the slogans. I do not start with what politicians promise. I start with what businesses pay, what consumers cut, and what markets can no longer pretend not to see. That is where the real story lives. Most people think a trade war hurts markets because investors get scared of bad headlines. That is true, but it is only the surface. The deeper reason is that a market is always trying to guess the next 12 months before the next 12 months arrive. It is not looking at today's shelves or today's jobs report and saying everything is still fine. It is looking past them. It is asking what happens when parts cost more, shipping gets slower, buyers pull back, companies freeze spending, and other countries hit back. Once that change starts, the market does not need full proof. It only needs enough evidence to believe future profits will be smaller than people thought a week ago. That is why trade wars hit stocks so hard. A stock is just a claim on future cash. That means future profit. If I believe a business will earn less next year, I pay less for that business today. It is that simple. And a trade war attacks future profit from both sides. It raises costs on the way in and weakens demand on the way out. So the squeeze comes from both directions at once. Companies pay more to make what they sell, and they may sell less of it anyway. I have seen people say, but tariffs only hit foreign goods. That sounds clean, but real business is never clean. Supply chains are tangled. A car built in one country may have parts from 5 others. A phone may be designed in California, assembled in Asia, and filled with parts that crossed borders more times than most people ever will. When a tariff lands on one point in that chain, it does not sit still. It moves. It moves into factory plans, shipping costs, inventory decisions, store prices, and boardroom fear. The market understands that faster than the average headline reader does. Look at what happens to a company's margin. Margin is the money left after costs. If import costs rise and the company eats the cost, margin shrinks. If the company passes the cost to the customer, demand may shrink because people do not like paying more. Either way, something gets worse. And during the tariff shock, people started to see that clearly. A projection even showed that a high-end iPhone, if the added cost were passed on, could move toward roughly $2,300. I do not need that exact number to come true to understand the warning. I only need to see what it says about pressure. Then the second punch arrives, retaliation. Trade wars are almost never one move. They are a chain of moves, and each move makes planning harder. China answered with a 34% tariff on U.S. goods at one point in the recent flare-up. That matters far beyond politics. It means American exporters can get hit just as importers get hit. So now the story is no longer just about higher costs inside the U.S. It is also about weaker sales outside the U.S. That is how a policy that sounds protective can quickly turn into a profit problem. I pay close attention to how business leaders act when this happens, because behavior tells me more than speeches. When tariffs were rolled out on a wide scale, companies did not respond with calm confidence. They started adjusting. Stellantis moved to temporarily lay off 900 U.S. workers and pause production in some places while it assessed the impact. That matters. It tells me the problem is not abstract. It is already moving through payrolls, schedules, and real lives. Markets do not wait for that to spread. They start pricing the spread the moment they see the first crack. So let me ask you something. When your own money is in the market, are you reacting to price moves, or are you trying to understand the machine that creates them? That difference matters more than almost anything else. Because while many small investors were rushing in to buy the dip, large pools of capital were doing the opposite. Retail traders bought about $4.7 billion of stocks in one big burst during the early panic. At the same time, hedge funds and fast money were dumping risk. When I see that split, I know I am not looking at one emotional crowd. I am looking at two very different time horizons colliding. That collision is exactly why these sell-offs feel so violent. One group says, this is a bargain. Another group says, this is only the first reset. And when the second group controls more leverage, more models, and more risk limits, the tape gets ugly fast. In one 2-day stretch tied to tariff fear, U.S. stocks fell more than 10%, and the NASDAQ moved into bear market territory. A bear market simply means a drop of 20% or more from a recent high. That is not a mood swing. That is the market saying expectations have changed in a serious way. I also watch fear itself, because fear has a price. The VIX is one of the market's fear gauges. It measures how much investors expect prices to swing. In plain words, it tracks how wild they think the ride is about to get. During that tariff panic, the VIX closed above 45, its highest level since the shock phase of 2020. That is not normal fear. That is stress. That is the kind of reading that tells me traders are no longer debating whether this matters. They are paying up for protection because they think the damage can spread beyond one bad news cycle. And the bond market started saying the same thing in a different language. The U.S. 10-year Treasury yield had been above 4.8% earlier in the year when people were still dreaming about faster growth. Then trade war fear hit, money rushed into bonds for safety, and that yield dropped toward 4% and even below it in the panic. A yield is the return on a bond. When fear rises, investors buy bonds, bond prices go up, and yields fall. So that drop was not random. It was the bond market whispering recession before the stock market finished shouting it. This is the part many people read wrong. They hear tariffs cause inflation, and they assume yields should rise, not fall. But markets do not price one thing at a time. They price the mix. Yes, tariffs can push prices higher, but if they also hit growth hard enough, the market starts worrying about slowdown first. That is why a trade war can feel like both inflation and recession at once. Higher prices with weaker growth. That is a nasty mix because it gives central banks a bad set of choices. Cut rates too soon and inflation can stick. Hold too tight and growth can crack harder. I think about this through normal people, not just charts. Imagine I run a small business that imports parts, sells to middle-income families, and already works on thin profit. My parts now cost more. My customers are more cautious. My bank is less eager to lend. My suppliers want faster payment because they are nervous too. I cannot plan 6 months out because I do not know what the tariff rate will be or who will retaliate next. So I delay hiring, I delay expansion, I delay orders, and if enough people like me do that at the same time, the whole economy starts slowing before the data fully shows it. That is why I never laugh off uncertainty as some soft, harmless word. In markets, uncertainty is expensive. It delays spending, and delayed spending becomes lower revenue for someone else. That lower revenue becomes lower earnings guidance. Earnings guidance is what companies tell investors about what they expect to make. When that guidance falls, stock prices often fall before the actual earnings report even arrives. So when people ask me why the market is collapsing during a trade war, my answer is simple. Because uncertainty is not an emotion in this case, it is a direct attack on future cash flow. So I want to ask you another question. If a company you own needs stable supply chains, low input costs, healthy consumers, and easy credit, have you checked which of those 4 pillars is still standing strong right now? This is where many investors learn the hard way that a good company and a good stock are not always the same thing at the same time. A business can still be real, useful, and well managed, and its stock can still get crushed if the market suddenly sees a weaker next year. That is not unfair. That is repricing. History helps me stay calm here because this pattern is not new. Back in the 2018 to early 2019 trade war period, the S&P 500 fell about 15%, while the MSCI Asia ex-Japan index dropped around 25%. Asia took a harder hit because it was more directly tied into the trade machine. This time, the scale has looked even larger in some moments. Estimates on the new tariff structure pushed the effective U.S. tariff rate into the low to mid-20s, around 23 to 24%, which would put it at the highest level in more than 100 years, and even above the level linked to Smoot-Hawley in 1930. That last comparison matters, but I use it carefully. I am not saying every tariff shock becomes the Great Depression. History never repeats in a clean costume, but it does rhyme. Smoot-Hawley did not break the world all by itself. It poured fuel on a system that was already under stress. That is what trade barriers often do. They hit when debt is high, politics are tense, and trust is weak. They do not need to create every problem from scratch. They only need to worsen the ones already there. That is usually enough for markets to break lower. Now, I know the strongest objection, and I think it deserves a fair hearing. Some people will say tariffs are painful in the short run, but good in the long run. They will say domestic factories come back, supply chains get safer, and the country becomes less dependent on rivals. I do not dismiss that argument. In a narrow set of industries and over a long enough time, some of that can happen. A nation may decide that paying more is worth it for security. That is a real choice. But the market is not collapsing because it cannot imagine long-run benefits. It is collapsing because the bridge to that future looks expensive, slow, and politically unstable. Factories do not appear because of one speech. They require land, power, permits, machines, engineers, suppliers, and customers who can still afford the final product. That takes years. Meanwhile, the tariff bill shows up now, the retaliation shows up now, the inventory mess shows up now, the squeeze on margins shows up now. So even if the long-term goal has logic, the market still has to survive the transition. And if companies believe the rules might change again in 3 months, they will not commit big money with confidence. Capital hates fog. That never changes. There is also a power layer to all this that people miss. A trade war is rarely just about trade. It is about leverage. It is about using access to markets as a weapon. It is about showing strength to voters, pressure to rivals, and resolve to allies. That means the economic logic can get mixed with political theater, and markets hate theater when theater writes the rules, because now the investor has to price not only demand, wages, and rates, but also ego, timing, and retaliation. That is a much messier game. Do you see how the risk stops being about one tariff and starts becoming about the whole rule book? When that happens, institutions move in ways that can make everything feel worse than the economic news alone would suggest. Some funds are forced sellers. That means they do not sell because they changed their minds. They sell because their rules make them sell when volatility jumps or losses hit a limit. During the tariff shock, reports showed hedge funds and levered exchange-traded funds unloading more than $40 billion of stocks at a blistering pace. Another estimate said volatility targeting strategies could have tens of billions more to sell. That is how a policy shock becomes a market air pocket. Price falls, rules force sales, and forced sales push price down again. Meanwhile, the public often does what the public has been trained to do in the last bull market. Buy the dip. I understand why. That habit worked for years, but habits built in one regime can get punished in another. If the problem is just panic, buying the dip can be smart. If the problem is a change in earnings power and a change in the world trading system, the dip can keep dipping. That is why I do not mock small investors for buying weakness, but I do worry when people assume every drop is a gift. Sometimes a drop is a message, and the message lately has been blunt. Big banks raised recession odds as the tariff fight deepened. One major call moved global recession risk from 40% to 60%. Jerome Powell himself warned that larger than expected tariffs were likely to mean higher inflation and slower growth. That is a bad sentence for markets. Higher inflation and slower growth together means pressure on both consumers and policymakers. It also means the Federal Reserve cannot rescue risk assets as easily as it could in a clean recession. The Fed can fight weak growth. It can fight inflation. Fighting both at once is much harder. So what happens next? I see three broad paths, and I hold all three in my mind at once. The first is the relief path. The market falls hard, pressure builds, deals get made, tariff rates soften, and stocks bounce sharply because the worst case never fully arrives. This happens more often than people think. Markets can sell off faster than reality deserves, especially when forced selling joins the party. If we get that path, the rebound could be violent. But violent rebounds do not always mean the system is healthy. Sometimes they only mean the first fear was too extreme. The second path is the grind path, and this one is more dangerous because it is slower. Tariffs stay high enough to hurt, but not high enough to force a quick political retreat. Companies keep cutting guidance. Hiring cools. Consumers notice higher prices on the things they actually buy. Credit gets a little tighter. Nothing breaks in one dramatic week, but confidence keeps leaking out month after month. In that world, the market does not need one crash. It can simply keep stepping down as hope gets revised lower. Those are hard periods because people do not know when to stop calling every decline temporary. The third path is the split path. Some parts of the market suffer while others start to benefit from the rewiring. Domestic defense, selected industrial names, some materials, parts of automation, maybe infrastructure tied to onshoring could hold up better. Onshoring means bringing production back home. But even in that path, I would expect a rough and uneven process, not a clean national comeback. Some sectors would gain, others would lose, and the broad market could still struggle while a handful of politically favored areas outperform. If this kind of slow, honest thinking helps you see the risk more clearly, keep walking with me through it. What do I do with my own thinking in a moment like this? I get simpler, not fancier. I watch earnings revisions. I watch credit spreads, which are the extra interest weak borrowers have to pay. If those spreads widen, stress is growing. I watch job cuts, capital spending plans, and whether bond yields are falling because of fear or rising because buyers no longer trust the debt. I watch whether the trade war is becoming negotiation or whether it is becoming identity. That last one matters. Once policy turns into pride, compromise gets harder, and markets usually figure that out before politicians do. I also become more honest about time. A trader, an investor, and a worker do not experience the same market the same way. A trader may care about the next week. I care about whether the next 2 years will look different from the last two. And a worker cares about whether next quarter brings fewer shifts. When I keep those time frames separate, I make fewer emotional mistakes. I do not confuse a bounce with a cure. I do not confuse a dip with value. And I do not confuse patriotic language with sound economics. Markets are cruel teachers, but they are clear ones if I listen. So no, the market is not collapsing during a trade war because traders are weak or spoiled or unable to handle a little political noise. It is collapsing because trade war risk reaches into prices, margins, demand, hiring, credit, confidence, and policy all at once. It turns the future cloudy, and markets hate cloudy futures more than almost anything. That does not mean the world ends here. It means the easy assumptions end here. And once those easy assumptions die, price has to find a new floor. When I strip away the noise, I come back to one simple lesson. Markets can survive bad news. What they struggle to survive is a world where the rules keep changing while profits keep shrinking. That is the danger inside a trade war. Not just higher tariffs, but a lower ability to plan. If you remember that, you will be calmer than most people and safer than most people when the next headline hits. Because the market does not collapse when the public feels fear. It collapses when the future stops looking dependable